Welcome to the Daily Update Podcast, where I'll go over the action in the market for Friday, October 3rd, and we'll see how things look for Monday, October 6th. Recapping Friday, October 3rd, it was a relatively quiet day, although the S&P barely set a new all-time high. The S&P 500 closed virtually unchanged, up just 0.01% on below-average volume. Despite the lack of movement, the Dow and S&P both managed to set new all-time highs, though these gains were modest and lacked strong follow-through. The absence of the anticipated employment situation report, delayed due to the ongoing government shutdown, contributed to the subdued session. Mega caps, large caps, and tech stocks underperformed, which kept the market from gaining significant traction. Looking at the economic data that was released, as well as Fed commentary, while the employment report was postponed, we did receive some economic data. The S&P Global U.S. Services PMI rose to 54.2, signaling continued expansion in the services sector. However, in the U.S., the ISM Services Index came in weaker than expected at 50, teetering on the edge of expansion and contraction, down from 52 in the prior reading. This softer-than-expected data may reinforce expectations of a Fed Reserve rate cut coming up later in October, with the markets pricing in reductions for not only October but December as well, and at least one cut is projected for 2026. There was some Fed speak on Friday. Fed Chair Jefferson, a voting member, emphasized the Fed's dual mandate of controlling inflation while fostering a positive employment environment, while at the same time keeping prices stable. Meanwhile, Governor Goolsbee cautioned against aggressive rate cuts, urging a measured approach as the Fed assesses incoming data, or the lack thereof due to the shutdown. Moving on to technical analysis and market trends. From a technical perspective, the S&P 500 did open higher, briefly surpassing R1 at 6734 and reaching 6750, but it fell short of R2 at 6752. After retreating and dipping below R1 and briefly turning negative, the S&P found support at the daily pivot at 6714 before closing slightly positive. Short-term indicators such as the 20-period moving average remain bullish, but momentum is waning, with the short-term RSI and stochastic oscillators showing signs of overextension while declining. Intermediate-term indicators, including the Chaikin oscillator, have now turned negative, reflecting a lack of conviction. Longer term, the market remains above the 50 and 200-day moving averages, but its distance from the 200-day average, over 11%, a level that has historically preceded more significant pullbacks. Despite this, the advanced decline line and volume-based indicators continue to support a bullish trend, with new highs in both price and volume. Looking at sector performance and sentiment, sector performance was mixed. Growth stocks, particularly in tech and discretionary, lagged, with Tesla notably declining after its earnings report. In contrast, value sectors, including utilities and healthcare, showed relative strength. Market sentiment remains neutral, which, in a contrarian sense, supports the market's resilience as skepticism persists. The VIX remains low, indicating little fear, though the VIX to S&P 500 correlation is rising, hinting at potential short-term volatility. Looking ahead to Monday, October 6th, no major economic reports are expected to be released. Investors will likely focus on the Fed meeting minutes, which will be released on Wednesday at 2 p.m. Eastern, for clues on the Fed's rate cut timeline. Seasonality data suggests a positive bias for the Dow and neutral to positive for the S&P and NASDAQ in early October, particularly in post-election years. However, without significant catalysts, the S&P may continue its current trend of mixed conviction. In conclusion, the S&P 500 continues to hold up remarkably well, setting new highs despite a lack of strong momentum and the absence of key economic data. While short-term indicators show some weakness, the longer-term trend remains positive, supported by solid earnings and a lack of recessionary signals. Investors should monitor support levels, particularly the 20-day moving average and the 6,700 level on the S&P, as well as the upcoming Fed meeting minutes for further direction. Thank you very much, and I will talk to you in the next podcast.